After a downtrend in recent days, the question now is not about forecasting the next big move, but about understanding whether the market is preparing for continuation or simply digesting the gains. Instead of guessing, we will do what we always do: let price lead and let options confirm. Hi, this is Kamal. In this analysis, there are no predictions or trade calls. I am simply reading what price action and options data are telling us for Nifty for the current week. Let's begin, as always, with price because price is the final authority. Nifty is currently trading around 25,680, and this zone has now become an important decision area for the index. Price is sitting very close to the at the money region near 25,700, which also coincides with a major options equilibrium zone for this expiry scheduled on 13th January. What matters here is not how Nifty reached this level, but how it behaves above and below this zone. With that context in mind, let us now check whether options data supports or contradicts this price structure. Starting with put open interest, we can clearly see a strong buildup of put OI between 25,400 and 25,600. This tells us very clearly that market participants are actively defending the downside in this zone. In simple terms, below 25,600, put writers are confident, which means downside risk is being absorbed for now. This establishes a well defined support base for the current expiry. Now, let us look at the change in the open interest, which shows us where fresh positions are created. Here again, we see fresh put additions below the ATM, particularly around 25,500 to 25,600, while higher strikes show signs of put unwinding. This confirms that the support we are seeing is not legacy positioning but fresh defensive activity. From a downside perspective, price action and options data are aligned. Now, let us turn to the other side, which is calls. Call open interest is clearly concentrated between 25,800 and 25,600, with particularly heavy positioning near 25,900 and 26,000. This zone acts as the immediate overhead supply area. So while the downside looks protected, the upside is not free flowing. Any move into this zone will face active call writing pressure unless price shows clear acceptance beyond it. We can see fresh call writing above the ATM, especially between 25,600 and 25,800, while there is limited unwinding near current prices. This tells us something important. The market is not aggressively chasing higher prices, but is comfortable selling into rallies. This is a classic range bound controlled behavior, not a breakout behavior. When we combine put and call positioning, we can see that max pain zone for this expiry is clustered around 25,700. With spot trading very close to this level, the market is currently sitting near an options equilibrium point. This further reinforces the idea that the market is in a balance phase where time decay and range dynamics dominate unless price decisively moves away from this zone. Now, let us check seasonality. This chart shows Nifty's performance between the 10th and 19th trading sessions over the last 15 years. On average, returns during this window have been mildly positive at 0.18% with a 60% win rate. With 108 positive periods versus 72 negative, this phase tends to favor consolidation and selective upside rather than strong trending moves. So let us summarize this week objectively. Price is holding above strong support zones between 25,400 and 25,600, but it is also approaching a clear supply zone between 25,600 and 25,800. Put writers are active on the downside while call writers are defending higher levels. This tells us that the market is balanced, not weak, but also not in a runaway trend. As long as price remains between these zones, the structure favors patience over predictions. Watch how price behaves around 25,700 region because that will decide whether balance continues or structure begins to shift. Finally, edge doesn't come from predicting the future. It comes from responding correctly when your conditions are met. Thanks for watching and always remember, trade what you see, not what you feel.